Hello, welcome back. Hopefully the tips and tricks video gave you some insight or gave you some suggestions on how to make this online experience more beneficial and hopefully makes you more successful. So this week we're going to talk about chapter 14. Now, very important. If you have not read chapter 14, you should stop the video and go read chapter 14. Okay? It's very important that the idea behind these online lessons, at least from my perspective, is that as you watch these videos, this is not your first exposure to the material, meaning you've read the book or you've read the chapter already. You have an idea of what the author is trying to get you to know or what you need to learn. Then you watch these videos. The idea behind the videos is that A, it reinforces what you read, which is important. B, hopefully it clears up maybe some misconceptions of something that you read in the chapter. And C, hopefully, it addresses maybe some questions that arose as you read the chapter. Okay? Again, if in the video I do not address your question specifically, it's okay. Why? Because we're going to meet every Tuesday for an hour and we're going to discuss the material. Okay? So, chapter 14 has to deal with dividends, retained earnings, and income reporting for corporations. So what should you be able to do by the time you have completed your studies of chapter 14? Well, you should be able to explain how to account for cash dividends. You should be able to explain how to account for stock dividends as well as stock splits. You should be able to prepare and analyze a comprehensive shareholders equity section. And you should be able to describe the form and content of the corporation's income statements. Okay? In this video specifically, we're talking about nothing other than learning objective 1, which is explain how to account for cash dividends. So, by the time you finish this video, you should know exactly how to account for cash dividends, meaning what is a cash dividend? How do we record a cash dividend? When are cash dividends paid? When are they declared? Who declares them? Okay? Those are some of the things that we're going to talk about. So, okay. So, the first thing that we need to understand about a dividend, what exactly is a dividend? Well, a dividend is a corporation's distribution of cash or stock to its shareholders on a pro rata basis. What the hell does pro rata mean? Pro rata means it's on a proportional, the dividend is based on the proportion of ownership in the company. Okay? And we'll get into a little later how we calculate that. But the most important thing that you understand here is what exactly is a dividend? Well, the corporation is distributing either cash or more stock to their shareholders. Now, there's a number of types of dividends. We have a cash dividend, which we're going to work on in this video. We have stock dividends, which we're going to see in our second video. We're going to get into how to calculate stock dividends. There's also property dividends and what we call scrips or promissory notes. Okay? Now, in the real world, stock dividends and cash dividends are the two primary distributions that corporations make to their shareholders, right? Property dividends, just know that they exist. In the real world, you're probably not going to see that, okay? One thing that's important for us to know is dividends. How do we report them, right? Well, they're reported on a quarterly basis, and they're always going to be reported as a dollar amount per share, right? So I don't know if any of you are watching the news, but as of yesterday, the stock market took a little dive, right? I think it was down 10%, almost 3,000 points. So, so as we're talking about dividends in the stock market, it's important to realize again that how do we report those, right? Well, you might see, Coca-Cola paid a dividend of 5 cents per share, or General Motors paid a dividend of 15 cents per share. Okay. Again, the key takeaway is the types of dividends that we have, what the dividends are, and again, how are they reported. Now, when we're going to pay a cash dividend, or let me phrase that, when a corporation is going to pay a cash dividend, they have to have three things, right? Number one, they have to have retained earnings, okay? Corporations that decide to pay dividends or to pay cash dividends specifically, they have to have retained earnings, right? So, what we're saying here is that in order to first declare a dividend, the company has to have retained earnings, okay? So the payment of cash dividends from retained earnings is legal in all states, right? Meaning if a corporation has no retained earnings, guess what? Cannot pay dividends, okay? Number two, the company has to have adequate cash on hand in order to pay those dividends, okay? Let's say we pay 10 cents per share per dividend, or that's what we declare, where we're going to pay it, okay? We're the board of directors. We have retained earnings. We have enough to pay the dividends out of our retained earnings. That's good. But we don't have adequate cash, right? Meaning we look at our bank account, we don't have enough cash to pay the dividends. So that's kind of a prerequisite in order for a corporation to pay those cash dividends. And then we need to have what we call a declaration of dividends. Basically, what that means is the board of directors and those people on the board are the only ones within a corporation that can declare that dividend. They vote and they say, the board of directors have a vote and they say, let's pay a dividend. All right, we declare we're going to pay a dividend. So those are the three main important antecedents, if you will, in order to pay a cash dividend. Now, there's three very, very, very important dates that we need to know. Three important dates that we need to know in order for, cash dividends to be paid. First is the declaration date. The declaration date is when the board authorizes dividends. Okay, the board votes, and they on December 1st, we declare a dividend. We voted. We all agreed we're going to pay our shareholders dividends. Okay, at that point in time, once they declare their dividend, that means that they have to pay it. Okay, so when we're looking at the declaration date, basically the declaration date is the date that the board of directors declared the dividend, or they voted to actually pay a dividend. But it actually commits the corporation to a legal obligation. When the board of directors say we are going to pay a dividend, guess what? We actually have an obligation, okay? Meaning we got to hit the books, okay? Because there is a legal obligation for us to distribute cash to our shareholders, okay? The second important date, let's back up here. The journal entry on the declaration date. What do? Very, very, very important. Make sure you have this in your notes. Put it on a note card. Memorize it. Do whatever you got to do to know this. What is the journal entry on the declaration date? Well, the first thing that we have to do is to recognize that we have an increase in a new account. That account is cash dividends. We also have another account which is a liability, the dividends payable. Okay? So when we declare a dividend, regardless of how much it is, okay, we debit a new account that we call cash dividends, and we credit a liability, dividends payable. Okay? Very important. Now, the second date that we need to know is called the record date. Okay? Basically, at the record date, this is where the company determines ownership of those outstanding shares, right? And the purpose for the corporation to do this is to figure out who we're going to pay dividends to. So, excuse me, as of the record date, we don't do a journal entry. This is where the corporation says, okay, on December 22nd, who actually owns our stock? Okay? Why is this important? Well, it's important because we need to know who to pay, right? Who is the owner on record as of the record date? Okay? Very important. Another important item with the record date is this requires no journal entry. Okay? Why? Well, because we already recognized the liability on the declaration date. Okay? Record date means nothing other than we want to figure out who owns our stock. Okay? And then finally, we have what we call the payment date. This is the day or the date that the company actually cuts a check and sends the dividend payment to the stockholder who we had on record as of the record date. Okay? So the payment date, again, that's when the company says, okay, we're going to pay our we're going to make our cash dividend payment to the stockholders of record. That's easy. Okay? What's the journal entry on the payment date? Very important that you know what journal entry do I make on the payment date. So, what do you think? Well, hopefully you remember the journal entry that we made on the declaration date. On the payment date, we just reverse that journal entry, meaning on the payment date, I have to debit dividends payable and I credit my cash. Okay, so let's look at an example here. All right, and this kind of goes over what we, excuse me, what we already talked about. Right. So let's say on December 1st, the directors of Media General declares a 50-cent per share dividend. Okay, cool. 50 cents per share. That's the dividend we're paying. We need to know how many shares are outstanding. Well, excuse me, we have 100,000 shares of $10 par value common stock. They tell us that the dividend is payable on January 20th to shareholders that on the record date, shareholders that actually own the stock on the record date of December 22nd. Okay. First journal entry we do is on the declaration date. So on December 1, we have an obligation. We need to debit cash dividends for $50,000. We need to credit dividends payable for $50,000. Okay? On January 22nd, that is the date of record. No journal entry do we need to make on the record date. That's just for the corporation that says, okay, if you own our stock on December 22nd, you get a dividend. Okay? Prior to that, December 22nd date, that stock's still on the stock market. It's still being traded. Okay? So what happens if on December 3rd, let's say December 10th, right? I sell the stock. I hold Media General. December 1st, they declare a dividend. December 10th, I say, you know what? I'm selling it. I don't care, right? I'm just selling it. Great. December 22nd rolls around. Do I get the dividend? No, because as of December 22nd, I don't own it. I sold it to somebody else, right? I sold it to Kenny. So as of December 22nd, Kenny is now the owner of that stock. Okay? Corporation makes no journal entry. On January 20th, that's the payment date. So on January 20th, Kenny gets a check for 50 cents per share for the stock that he bought on December 10th, right? Notice the journal entry on the payment date. We reverse what we originally did, meaning we need to decrease our liability, which is dividends payable. How do I decrease the liability? With a debit. So I'm going to debit dividends payable. I'm going to credit cash for $50,000. Of course, I'm crediting cash. Why am I crediting cash? Well, because my cash goes down by $50,000. That cash dividends, that's just kind of a sub-account under cash that we know what it is, okay? Excuse me. Now we need to talk about dividend preferences, right? Who gets paid first? It's a logical question to ask. So what is dividend preference? Well, when we're talking about dividend preference, basically it's who receives the dividend. Well, that makes sense. So a dividend preferences basically establishes a right to receive dividends before common shareholders, okay? So when we're talking about dividend preferences, what we're talking about is the preferred shareholders, okay? Think back to Chapter 13. Chapter 13, we recognized, or we learned, hopefully we learned, that there's two types of stocks classes that are out there, right? Primarily there's two. There's common and preferred. Okay, cool. So dividend preference refers to the preferred shareholders' rights to receive dividends before any common shareholders receive their dividends, okay? Very important that we understand that per share dividends, the amount, we actually state it as a percentage of the preferred stock's par value or as a specified amount. So right now we're just talking about preferred shareholders and their rights to receive dividends. They get it before the common shareholders. And we're talking about, okay, how do we report preferred stock dividends? Well, we can either do it as a percentage of the preferred stock par value, or we can do it as a specified amount. Now, we have something interesting here. We have what we call cumulative dividends, okay? What exactly is a cumulative dividend? Well, when we're talking about cumulative dividends, it's a feature of the preferred stock, and this feature stipulates that preferred shareholders must be paid both the current year dividend and any unpaid prior year dividends before any common shareholders are paid dividends, okay? So we have two types of dividends here. We have the current dividend and we have what we call dividend in arrears, okay? When we're looking at dividend in arrears, those are the cumulative preferred dividends that were not declared in a given period, okay? What are we talking about here, right? Well, think about it. When we're talking about preferred stock, right? It has, and hopefully you remember from Chapter 13, it has a stated rate, right? Meaning we're going to pay you X percentage to these preferred stockholders, right? They're preferred. They have to get a dividend, right? It's stated on their stock of preferred shares, right? So there's always that, when we're talking about preferred stock, we're talking about they always have to get a dividend, right? Even if it's not declared, they still are entitled to it because legally they bought this stock based on, okay, well, it's preferred shares. I get my stock before any other common share, or I'm sorry, I get my dividend before any other common shareholder, and it's specified how much I get, okay? If the board of directors do not declare a dividend, that's okay. Preferred shareholders are still entitled to that dividend because it's stated in the stock, okay? Cumulative dividends, again, basically we're saying, okay, preferred stockholders, you got to be paid both the current year dividend that we declare and any unpaid prior dividends before the common shareholders receive any dividends, okay? So the common shareholder, they're last in line to receive any distributions from the company, whether that's dividends, liquidation, whatever. Common shareholders, they're full-fledged owners of the company. They're last to receive any receive any payouts. Okay, so very important you understand the difference between preferred and common rights when it comes to dividends, and we know what cumulative dividends are. Okay, so let's look at an example of cumulative dividends. Okay, so let's say that Scientific Leasing has 5,000 shares, 7%, 100 par value cumulative stock outstanding. Okay, what does that mean? That means that each $100 share pays a $7 dividend, right? How'd I figure that out? Well, I know that it's 7% times the par value, right? So that's how I got my $7 dividend. Now, the annual dividend is $35,000. How'd I figure that out? Well, that's easy. I got 5,000 shares of preferred stock outstanding. Each share is entitled to a $7 dividend payment. There's my 35 grand. Okay. Now, if dividends are 2 years in the rears, right? 2 years, preferred stockholders are entitled to receive the following dividends in the current year. Not a problem. How do we figure that out? Well, we have to calculate the dividends in the rears, plus we need to figure out the current year's dividends. Okay, so they tell us that dividends are 2 years in the rears, right? So year 1, we should have got $35,000. Year 2, we should have got $35,000. And year 3, which is the current year, we are entitled to $35,000. So if we add those up, excuse me, if we add those up and we take our $35,000 basically times 3 years, we get $105,000. That's the total preferred dividend. Okay? So let's look at this. Let's talk a little bit more about these dividend preferences, right? Allocating cash dividends between the preferred and the common stockholder, right? We kind of already gave you the answer. Let's kind of work through exactly how we're going to do this, right? So because the preferred stockholders have 5,000 shares of cumulative, that's the key word, cumulative preferred stock, they must be paid any of the unpaid prior year dividends, plus they need to receive the current year dividend before any common shareholders get any dividends. That's easy, okay? So let's look at it this way, right? We're going to allocate the cash dividend. It's a different example, but that's okay. We're still going to work through the logic, right? On December 31st, 2017, IRB Incorporated has 1,000 shares of 8% $100 par value cumulative preferred stock. So if you're asking yourself, well, how do I know if it's cumulative or not? We will tell you, right? The corporation will tell you that, hey, this is cumulative, right? Preferred stock all preferred stock is not cumulative, okay? What do you mean by that? Well, I need to buy preferred stock. Well, there's 2 types of preferred stock, cumulative or non-cumulative. Cumulative means that I need to receive any dividends in the rears before common stockholders get any dividends, okay? So they tell us that it has 50,000 shares of $10 par value common stock outstanding. So let's look at December 31st, 2017. The directors declare a $6,000 cash dividend. We need to prepare the journal entry as of the direct declaration date of the dividend. So remember, declaration date, that's when we have a legal obligation. That's when I got to do a journal entry. What journal entry am I going to do? Well, I'm going to debit cash dividends. I'm going to credit dividends payable for $6,000, right? Well, why $6,000? Because they tell us, hey, this is what the directors declared. We're going to pay a $6,000 cash dividend, okay? Here's the total amount that we're paying. What's the what's the per share value of that? Well, I need to figure that out. The company just told us we're paying $6,000 in dividends. We need to figure out what we're going to pay, okay? So let's see what we got here. We acknowledge the fact that there is a legal obligation for the $6,000 cash dividend, right? Cash dividends debited, credited, dividends payable. That $6,000 is not enough to cover our preferred dividends. How do I know that? Well, I know how to calculate preferred dividends. I take the number of shares times the par value per share times the stated rate, that 8%. So the preferred dividends are actually $8,000, okay? So let's think about this. At December 31st, 2018, IBR declares a $50,000 cash dividend. We need to show the allocation of the dividend to each class of stock. Not a problem, okay? So in 2017, right, the dividends were declared were $6,000. How much did we prepare, or how much did we allocate to the preferred shareholders? Well, we gave them all $6,000, right? Why? Because they're preferred shares. They have to get paid before any common shareholders. That's number one. Number two, it's a cumulative dividend, or it's a cumulative preferred shares. So that means that I need to keep track of how much I pay them versus how much I owe them. Okay. So we say we're going to pay $6,000. We give all that to the preferred shareholders. Remainder to the common shareholders, well, they get nothing, right? Why? Because we got to pay the preferred shareholders first. Now, in 2008, right, IBR declares a $50,000 cash dividend. Okay, cool. 2018, we're going to pay $50,000 to our shareholders, right? Okay. First, I need to figure out what is my dividends in arrears. Well, in 2017, they were entitled to $8,000. Right? I figured that out right. Bear with me here. I figured it right down here. Okay? I didn't, like we said before, we didn't pay them enough, right? So we still owe them $2,000 in the arrears. How did I figure that out? Well, that's easy. I take the 2017 preferred dividend of $8,000 minus my declared of $6,000. So that means I still owe preferred shareholders $2,000 of dividends in arrears. Okay? Excuse me. From that, I need to allocate the current dividend, or the current cash dividend, to the preferred shareholders. Well, we already know I owe them $8,000. How do we know that? Again, number of shares, 1,000 shares, times the par value of $100 per share, times that stated rate of 8%. I owe them $8,000 from this year's allocation of the dividend payment. So as you can see here, to catch up the preferred shareholders, I need to pay them $2,000 from dividends in arrears from 2017, and I need to pay them their dividends this year, 2018, which they're entitled to $8,000. So how much is left to disperse to all the common shareholders? Well, we take the dividend that we declared of $50,000 in 2018. We include any dividends in arrears that we must pay them, and we include this year's dividend. That totals up to $10,000. Okay? That means that we have $40,000 left to distribute to our common shareholders. Okay? So what are the journal entries now? Well, pretty simple, right? On December 31st, 2018, since we declared the dividend, what do we have? We have a legal obligation, so we got to do a journal entry. We are going to debit cash dividends for $50,000. We're going to credit dividends payable of $50,000. That's on December 31st, 2018. So let's look at a quick example here, right? Mastermind Corporation has 2,000 shares of 6% $100 par value preferred stock outstanding at December 31st, 2017. At December 31st, 2017, the company declares a $60,000 cash dividend. Determine the dividend that needs to be paid to preferred shareholders and common shareholders under each of the following scenarios. Okay? So let's look at it this way. The first scenario says the preferred stock is non-cumulative. The company has not missed any dividend payments in previous years. Well, okay. So we only got to focus on the preferred shareholders that are paid for this year's dividends. How do we do that? Well, it's easy. Preferred stockholders, they get 12 grand of this $60,000 dividend. How do I know that? Again, and you should definitely, I've said it numerous times, you should probably put this in the notes. How do we calculate the dividends in total that we have to pay? We take our number of shares outstanding, 2,000, times 6%, which is that stated rate, times the par value per share, which is $100. Preferred shareholders get 12 grand. Okay. How much is left to distribute to common shareholders? Well, that's easy. We take the total dividend declared, $60,000, subtract out the preferred shares, $12,000. That means that we have 48 grand of common shareholder, or $48,000 to distribute to our common shareholders. Now we're going to look at the same exact thing. Now, let's say that in this case, the preferred stock is non-cumulative. The company did not pay a dividend in each of the 2 previous years. Here's the key. It's non-cumulative, right? Those past unpaid dividends, we don't care about, right? We don't have to pay them because why? The preferred stock's non-cumulative. Exactly. So calculating how much we have to pay preferred shareholders, how much do we have to pay common shareholders, or how much do the common shareholders get? It's the same calculation. Okay? Now, what if, for example, the preferred stock is cumulative? The company did not pay a dividend in each of the 2 previous years. Easy peasy, right? Super easy. What we need to figure out is, first, how much do we pay preferred shareholders? Well, that's easy. The number of shares outstanding times the stated rate times the par value per share. But we need to remember that there are 3 years that we have to pay. We have to pay the 2 years that are in arrears, and we have to pay the current year. So we take 3,000, or I'm sorry, pump the brakes. We take 3 because we have 3 years of dividends that we need to pay these preferred shareholders before we can even pay any common shareholders. Okay? Got to pay the preferred first. So we take the par value of $100 times the number of shares outstanding, 2,000, times that stated rate, 6%, times 3, right? Why 3? We're 2 years in arrears plus the current dividend. We have to pay the preferred shareholders $36,000. How much is left for the common shareholders? Well, that's easy. The dividend declared this year was 60 grand minus the 36,000 that we need to pay the preferred stockholders that have this cumulative stock. We get the 36,000. So common shareholders, the amount that's going to be distributed to them is $24,000. Okay? Excuse me. Now, when we come back in our next video, we're going to talk about stock dividends. But let's think about what we talked about to this point, right? We talked about the types of dividends: cash dividends, stock dividends, property dividends, scrip dividends, right? In the real world, what are we going to see? Cash dividends and stock dividends primarily, okay? When are dividends reported? Well, they're reported quarterly, and they're reported based on a dollar amount per share, okay? What are the 3 antecedents, or what are the 3 pre-qualifying things that we need in order to pay a cash dividend? Have to have retained earnings, have to have adequate cash, and the board of directors have to declare a dividend. We talked about 3 very important dates. The declaration date. What's the declaration date? That's when the board of directors says, we're going to pay a dividend. They authorize the payment of a dividend on the declaration date. We have a legal obligation. We have to make a journal entry on the declaration date. The record date. Well, there's no journal entry here. It's just the corporation wants to know, as of the record date, who are our shareholders that are eligible for our dividend. Okay? Then we have the payment date. That is when the company actually pays the dividend. They cut the dividend check to the shareholders of record. Payment date, we got to do a journal entry. Okay? We went through dividend preferences, talked about preferred shares, right? Preferred shareholders. We know what dividend preferences are. It's the right to receive dividends before any common shareholders. Okay? We know how we report these dividends, right? These preferred dividends. The per share dividend amount is going to be stated as a percentage of the preferred stock par value or a specified amount, right? We already saw this example, right? We said 2,000 shares at a stated rate of 8% with a par value of, $100, okay? We know what cumulative dividends are. We know cumulative dividends are those preferred shareholders that have stock or the preferred shareholders that did not receive any previous dividends. They should have, because it's stated in the it's stated in the preferred shares 8%, 6%, whatever. So when we're talking about cumulative dividends, we need to think about, are there any dividend in arrears? Are there any current dividends that need to be paid? Okay. We walk through an example of how to do the journal entries and how to calculate this. Okay. When we come back in our next video, we're going to go through some demo problems. Okay. So please tune back in for that video.